3, 2, and let's give her. All right. How's it going, everybody? Welcome to another episode of Trading WTF. Today we have two special guests with us, Victor Golovtchenko and Guy Cohen. In this episode of Trading WTF, we have two guests who build services to assist traders. Victor is developing TradeStar to keep traders informed with relevant real-time news, actionable, in-depth analysis, forecasts, and education. Guy is the founder of Wise Traders, an innovative provider of stocks and options software, services and trading education for private investors powered by patented technology. We're going to explore how news and analysis can help traders time the market and their entries. A little bit of background about both of them. Victor has been trading forex, equities, and commodities since 2004 and develops day trading and swing trading strategies. Besides trading, Victor is a financial markets journalist, previously reporting for FX Trader magazine and Finance Magnates. Currently, Victor is the product designer and editor-in-chief for TradeStar, a brand new financial news portal providing an innovative way to simplify complex financial news into actionable information for retail traders. For Guy, every day, tens of millions of dollars worth of stocks and options are traded by professional money managers and home-based traders using Guy Cohen's patented OVI system. Guy's client list includes the New York Stock Exchange, professional money managers, and the like. He has written several best-selling trading books published by FT, Prentice Hall, and Wiley. His expertise originates from an MBA in finance at Cass Business School in the heart of London's financial district. Many find Guy's unique appeal in his ability to communicate proven concepts, empowering you to trade them yourself. For more information about Guy's trading applications, go to wisetraders.com. All right, let's just jump into things. I'll give you both an opportunity to add anything or adjust anything that I just said, and maybe tell us a little bit how you got involved in trading and what attracted you to it. Let's start with Guy.
Thanks, Michael. Well, what got me into trading? I was always interested in financial. My first career in my early 20s was actually in real estate, but one of the weaknesses that many people in real estate have is they don't really understand finance. So I was always interested in that even before I got into real estate. But long story short, I was in my real estate career. I had a nasty illness. I got over it, and rather than going into the city, which is what I really wanted to do, I took a finance MBA. In that finance MBA, I specialized in having got over a nasty illness. I decided to test myself and choose the most difficult electives. So that included options. And there were two professors that I had in this field. One was a very nerdy kind of academic, and the other one was a visiting professor who was working with major banks and had made his own fortunes trading mispriced options. But in separate lectures, they both said, if you want to make money in the markets, follow what the options traders are doing. So I felt that that there was a certain logic to that, given that options traders are trading with leverage, and that was the start of what I didn't realize at the time would be a very long journey trying to master that situation. There's a lot of, with options data, there's literally billions and billions of rows of data in US equities options data. And it needs organizing, it needs cleaning, it needs arranging, then you need to put algorithms through it, and you need to have quantitative analysts, you have to have data scientists, you have to have industrial sized servers. Anyway, this became my obsession. And over the years, I kept on building up my expertise and my team's expertise in this data, as we were also building up our expertise in actual trading. And we found quantitatively and also from a discretionary point of view as well as quantitatively, that options transaction data really produces or creates an advantage, a palpable, measurable advantage. And so we use that for our discretionary trading, and we use it for our funds as well. And that's how I got into trading. It was first as an academic, but then progressing to practical trading strategies.
Like what you say, follow the options, because options talk about the future price and not the price where it is today. And I guess that's the
Well,
idea.
yes, look, the key part to it is this. With options, as you know, there's two main reasons why people are trading options. They're either hedging or they're building positions. And there are other bits of noise in there like income and other strategies and volatility strategies. But the two big ones are hedging and position building. Now, if you can find a way to isolate what is more likely to be position building, then that's much more important and interesting information than hedging activity, because it's aggressive. It's where risk is being taken, not being diluted. And so that's what we aim to isolate through our algorithms, and then we will then put those findings on top of other analysis that we do. And that's the essence of what we do. So, but yes, we're looking for aggressive position building. That's the real key.
And Victor, how about yourself? How did you get involved in trading?
So my story is kind of the opposite. My academic background is in economics. However, from a purely practical standpoint, I was on an internship during a summer in the US, and when I came back with some saved US dollars, I started wondering whether I should flip them to euros or should I just keep them in US dollars. And this is how I started getting interested in the forex market. I read a lot about what's impacting foreign exchange prices. And at some point in time, I just decided that, hey, maybe this is a way to generate good income on the side. So that's basically what happened for about 10 years when I crashed and burned. And I became a journalist, realizing that I need to have this kind of safe income in order to have the opportunity to let my positions play out and basically to wait long enough to be outside of the market, which I think that many traders are lacking. Like knowing when not to trade may be more important than when to trade.
Yeah, I think that's a big point, actually. If you look at my most successful members, one who's 15x their account in 2.5 years, her average number of trades per week is 1.19. Then there's another lady who's like almost 10x their account in 9 months last year. Her average number of trades was 1.28 trades per week, just over a trade a week on average. So that means some weeks they'll do 2, 3, or 4, and many weeks they'll do nothing. I got a guy who's made $685,000 through us, and he's had months at a time where he did nothing, partly for personal reasons, to be fair, but it goes to show that the speed of the acceleration of the growth of your account is probably inversely related to the number of trades you make. Albeit that we know that compounding can work its magic. It's about quality, not quantity. That's what we find too.
Yeah, I couldn't agree more. From my personal experience and from what a great book by Michael Lewis brought to light, mainly high-frequency traders are the ones making money on quantity of trades. So if you don't want to compete with those guys, just stay out and stay safe as long as you can and measure your risk.
Yeah, well, that's exactly it. There's the two types of traders. There's the long term. You can sit and hold a position. Like if you're going to sit and hold a position, you're going to be in the market to catch the moves. Whereas if you're just trying to catch the move on a daily basis, you're going to more or less cut yourself at the knees. And secondary, if you're trading to support yourself, there's a lot on that psychological level. It's a lot harder to wait for the positions to mature and get where you're what you're targeting for.
So yeah, for all those out there who are dreaming to basically sustain themselves on trading, you might want to give it a second thought and just take this as a yield farming approach or something. Like this is a popular term that surfaced with the cryptocurrency space. But yeah, just having this solid income is important for every trader, I think.
What exactly is yield farming? Because I think of it like you're playing a video game and you're farming on the video game. But
well, what happened with decentralized finance in cryptocurrencies is basically this new phenomena of staking cryptocurrency and waiting out for some time by lending it to other people to basically make money.
Okay, so it's kind of like lending money so they can monetize it, lend off of it, and then bring like a yield from it, like a return.
Pretty much. It works very well until the cryptocurrency keeps booming. But what happens when it starts falling? We're probably about to find out.
How do you hedge that stuff? Yeah.
It's very interesting that because obviously you've got all these, the meme stocks and crypto has gone crazy. And you've got all these new expressions like hodling, hold on for dear life. And as I explained to certain, my members, I said that's actually not a trading strategy. It's actually counterproductive. But I think these young people who are coming into the markets, at some point they're going to learn some pretty important lessons, which hopefully a good number of them will take it on the chin and come back and try and do it in a different way. But it'll be very interesting to see what happens.
Well, isn't hodl and diamond hands the same thing?
Say again?
Hodl and diamond hands? Like where you have hands of like, I don't know, that you can keep on holding a position that is losing money, but you think it's going to go in the long term?
It's called hold on for dear life.
Yeah, exactly.
It's a different animal to what we think we should do, but they're young. They could probably handle what will happen to them, and they'll come again and figure out that there might be other ways that they could do well. But one of the big things that I think that most people just don't do in trading, we found the most common mistake that people make is they don't protect their profits. When they're there to be protected, even a modest profit can be protected, should be protected. And most really big losses come through positions that have actually had a decent profit at one point. The easiest thing to do is have a stop loss. That too is a big mistake. But the bigger mistake is when the stock has actually risen in your favor and you're doing this hodling thing, thinking it's going to 10x, 100x, whatever, doesn't happen. But then you're holding on, waiting for it to go in your favor again. And this is when you see in crypto, I get told, oh, this one's going to go up 200-fold. It's like 1 cent now, but it's going to be $20. And on what basis are you saying this? Where's the now it might well do it. I mean, look at Dogecoin. It just did it, but it's very difficult to analyze some of this stuff. I'm not anti-crypto at all. I'm in a few crypto coins, and my criteria for that is, have they got a use case? But and even then, my knowledge is very sketchy. I have to admit. I know stocks and options. That's my thing. But my thing for crypto is, if it's got a use case, then it might have a chance. Might be worth a punt. But it's not a strategy. It's not my retirement fund.
Have you heard of the metaverse? Maybe you can retire in the metaverse.
Which one's it called?
The metaverse. It's essentially like an online world.
Oh, the metaverse.
Where you can buy property and then stay inside your house online in the 3D virtual world.
Well, this is a very interesting thing you say, because one of the coins that I did go into was one attached to gaming. And what I didn't realize, as a person my age and with the career I've had, is the whole gaming community, there's this whole world these guys inhabit where they buy and sell stuff on it, swords and grenades and, all this, game stuff that they're playing with, and it's what's interesting and to me on that one is they are real transactions within this other world. And so in that situation, the coin that I was interested in had an economic use. It was being utilized and churned like anything. And so that, again, to my somewhat untrained eye, had some substance to it. So we'll see how that goes. It's done okay actually since I got into it, but it's nothing special, but held its own and done okay. But those ones I kind of conceptually sort of understand. But the other stuff, the stuff that just comes out of thin air, I suspect one day will vanish back into thin air, but who knows?
Well, yeah, it's kind of the evolution of World of Warcraft. And if Jeff Bezos bought Twitch and universal basic income is coming, everyone's going to be in the metaverse or online pretty soon, just playing
That's
around
right.
and living in a dream world while Jeff Bezos delivers everything you need.
Yeah, well, I've actually tried some virtual reality, and it's very consuming. I mean, it really is. It's very interesting stuff. You really are in that world, and when you come out of it, you go, "Wow, I had a real experience there." I think they should use it for therapy and stuff like that. I mean, it could be amazing for that. So I can see a lot of uses for it.
Oh yeah.
Slightly uncomfortable. It's like pretty heavy on the neck, but But what's incredible about that world is the sheer numbers of people who inhabit it around the world and the amount of hours every day they spend in it. It is mind-boggling. So it's real.
Well, the way things are going, it might soon be much cheaper to live in virtual reality than in real reality. So might be an escape hatch for some people.
Yeah, and you're probably right. I mean, I think that reality is somewhat more fun. I mean, look, let's be honest. I mean, there's more opportunities now than there's ever been for anybody. You can have an opportunity in your home piped into you at pretty big and fast internet speed for very little money. Good education, unfortunately, and bad education is available. Good information and bad information is available, but there's never been an easier time for people to upskill. It's just the problem is, or the challenge is, upskilling with the right people, with the right information, because there's an awful lot of nonsense out there as well.
You mean I shouldn't follow those Instagram influencers?
That's another whole thing, but there's some really good stuff out there, and I do think that people perhaps need to consider that what they might have found extremely difficult once upon a time to find in their local library or impossible is now available on a gadget instantly and typically and often for free or very cheap. So I think that at some point the habit of complaining that people need to get a grip and go, hang on, in many respects, good information is right at your fingertips like never before.
Well, they complain because they want everything given to them, but that's another.
Well, yes, I mean, and I think that is something that, there's a whole new conversation, whole sort of.
It's a culture thing. Yeah.
Yeah.
Well, let's jump into a little bit of meat and potatoes. Guy, can you briefly explain the options volatility indicator you created and how it helps traders?
Yes. So the OVI, the options volatility indicator, is an indicator whose raw materials are transaction data, including pricing and volume and open interest and all the things that go into an options chain and all the things that come out of an options chain as well. And we utilize that. We run algorithms through it. We create algorithms. And from that, what we're looking to determine is the likely bias of position building activity. So obviously, there's an awful lot to sort through. Now, you're doing that on all stocks. And we create not only an indicator for each stock in the S&P 500, well, actually each stock that's optionable, but also we create a market breadth type of indicator throughout all stocks in the S&P 500 with this information. So the kind of numbers we're talking about, and the database runs into tens of billions of rows of options data, and that's a lot of data, and it's a lot of dirty data in there as well. So that's a lot. There's a very big haystack, and the needle we're looking for is pretty small. But that's the information we're looking at running our algorithms through, and from that we create an indicator that is remarkably simple to look at, and it's patented as well. So the indicator is normalized from a minimum of -1 to a maximum of +1. And basically, when it's in positive territory for any length of time, then we are looking for it to correlate with a bullish looking stock. And when it's negative for any length of time, we're looking for it to correlate with a bearish looking stock. And within those parameters, there will be trading opportunities in certain times with certain conditions, which we're also looking to isolate. That is what the OVI is and does. And because of the way the algorithms work, we can then run filters and searches and quantitative studies through it as well. And with it, either for a quantitative fund kind of automated portfolio kind of thing, which is what we do for professional clients, or for discretionary type trading for our retail audience as well. So this intellectual property just splits into those different directions very nicely. And the beautiful thing is that the retail side doesn't interfere with the institutional side, nor vice versa. So we can run all of that at the same time. They're not mutually exclusive, but they don't interfere with each other.
And these indicators, we can like pin them on the charts and stuff like that. So
that's right. So at the moment, there's only one place you can get them, and that's through us. But we are in the process of discussing with, as you and I discussed this not long ago, didn't we? But we are in the process of discussing where else we might allow the OVI to be viewed and seen. Because what happens is this. Once someone finds it, uses it, they never want to let it go. They literally, that's it. That they're going to use it forever, pretty much. And so it's but we're not big at the moment by any stretch. We are a little niche outfit, and obviously I'd like a few more people to be able to get visibility on it. But it's very, very cool. What we do, well, I'll tell you, I know you have more questions for me, so I won't preempt the questions, but we simplify things dramatically because we take a view of the markets where we're looking at demand and supply, but we're looking at demand and supply of a certain type of investor, an investor who is willing who is taking more risks and playing with more money than others, and also one who probably, certainly by the algorithms we see, is in possession of superior information. Now, if you think about it, if you've got 1 million investors out there, which are the ones you want to follow? The ones that got good information, or the ones who are just noise? Well, we want to isolate the ones who have good information, see what they are doing, and we can do that. And we know we can do that because when you automate it with robust algorithms to let it go on its own, we come out winning. And so from a quantitative point of view, we must be isolating something that has information, that valuable information in it. Now, are you talking about 100%? No, of course you're not. But you're talking about a considerable edge. Absolutely. And that's why it works not just in the discretionary world, but also in the quantitative automated world.
Well, if Pierce or Stefan are watching from TradingView, we got to get you guys talking to Guy and see if we can make this indicator available on TradingView.
I did a webinar the other day, and they're going, "Can I get it on TradingView?" I go, "No," but that might change.
Not yet.
No, it was not. It was more like a not yet. But funnily enough, I know a man who might want to introduce it. So yeah, that's a discussion to be had. But also, you know, the other thing that people want in my universe is they are absolutely itching to have it based in a brokerage account. And so this is another thing that we want to think about is actually pivot to becoming a broker, because I think that no one's a broker here, are they? Is anyone a broker here? Yes. Well, you are Scandinavian. So yes, it's a discussion to be had. Now, obviously, it's US focused, but we think that there is, you know, if you could make things really convenient for people where they can see it and trade it right away, that's got to be a big advantage for people. And so, you know, we're open to that kind of thing as well.
Well, let me get you involved over there, Victor. Many traders follow economic calendars and scheduled announcements. What do many traders get wrong about fundamental analysis?
Well, you just mentioned that they're following scheduled announcements. I would say that their minds might be missing the unscheduled announcements, which are constantly happening around us. And just as an example, just as a recent example, we had a pandemic. We had a vaccine developed, which triggered the biggest rally we have seen for me personally in my trading career. This is something that traders are usually omitting, that while focusing on economic indicators, life goes on, things are happening around us every day. Politics politics and basically real life economics is dictating what happens with those economic indicators. So you don't need to know that you don't need to know a number that is late to that is usually much comes out much later to the party than you basically have use for it. Just as an example, you could have bought oil when you hopped on into your car after the lockdown, and having this as an indicator that oil demand is coming back. So basically, these things are happening every day around us. And while I know that there are many people which are focusing on economic data, I feel like this data is usually lagging and usually priced in.
Yeah, a good chart normally has that inside the technical analysis, has the fundamentals in there already, or showing that what's going to come. And from TradeStar, like, what kind of experience will the traders get? I'm used to investing.com, TradingView. What do they look for at TradeStar?
So what's different? It's that we have gathered a community of former bank traders that have been obviously replaced by machines in recent years. So most of them are now sitting at home and trading for themselves, or even managing some other people's money. And these guys have been on the street for quite a while, and they have a lot of knowledge, a lot of experience in the markets, and they're keen to share their take. So the the information that's going to be on TradeStar is basically differentiating from the rest with decades of professional experience. These people have been at trading desks at major banks, and this is an experience you can't get really elsewhere.
Sitting in the trader's chair, the bank trader's chair.
Yeah.
And Guy, can options data help traders time the market, or does it just provide smart money sentiment and trend direction?
Bit of both. As I mentioned earlier, we translated OVI into a market-based longer-term signal. And there's something to be said for that, because the shorter term you go, let's just say you're dealing with daily end-of-day charts, the shorter time frame you go with, the more signals you're going to get, the more noise you're going to get. So a cleaner signal is going to be a slightly longer term signal. And that's the kind of market timing signal, OVI driven, that we use for our funds, for our quant funds. And it was worked rather well. So to give you an example, last year when we had a 30% crash in the major indices in a period of 6 weeks from February to April 2020, our longer term signal did not kick in, because it's a longer term signal. It's just too fast. It fell too fast. It's kicking in on more secular movements. However, since that time, pre-crash, so let's talk February the 18th to today, our fund has outperformed its benchmark, the S&P, by over 40%. So what that means is that the longer term indicator was right. There was this hiccup in the market. It was short, sharp. It didn't trigger the long-term signal. Now, of course, for discretionary traders, they would like to trade that dip in the market as fast as it was. And so for that, you then need shorter term indicators. But of course, the shorter term the indicator, you are going to get false signals, depending on obviously how you're using that indicator. But in answer to your question, yes, check number one is the OVI and options transaction data can be used as market timing signals. But its primary use is for individual stocks, so getting alpha from an individual stock position. But the big answer is yes, you can do both. But if you were to tell me what would I rather use it for, one or the other, if I had a choice and I could only choose one, I would be using it for individual stock selection.
Individual stock selection.
But both are valid and utilized.
And I guess, Victor, you touched upon this a little bit, but why is it important to know if fundamental news has been priced into the market or not?
So this is something that is dodging a trader's mind consistently, and it's basically very difficult to know how much of a certain item of news has been priced into the market. So the most reliable way to kind of digest that would be to look at the price action after a certain news item hits the wires, and that's something that a lot of traders are missing, and they feel like they know what the market is expecting, judging by the average consensus estimate. However, in reality, they don't know what portion of the market is looking at what consensus numbers, because obviously these average consensus numbers that are published on economic calendars are usually an average, and that's pretty much it. So if there is 10 traders which are looking at the top forecaster, they have the biggest volume in the market, they have a completely different approach to this matter. So this is something that traders should be mindful of.
And does news affect the OVI indicator, or is the options indicator not focused really on news for Guy?
Well, it's very interesting, because obviously what goes into the OVI includes pricing. So you're talking about implied volatility, and obviously implied volatility, which is obviously focused on the time value portion of an options premium, will deviate significantly in the lead up to earnings and in the aftermath of earnings in particular, and if there are other factors going on, but particularly pre-earnings and post-earnings. So there is news or anticipation of news and anticipation of future events woven into options pricing anyway, in fact, as much as woven into pricing of the underlying, if not more in that respect. Now, the question is, as Victor said, is what do you interpret from that? And obviously without the benefit of hindsight, because if that's the one piece of the game we don't have, that piece of the puzzle. Now, what we do see with OVI in many instances is correct analysis being done by way of what the OVI is saying in the lead up to earnings, and then when you see the aftermath of earnings. And there are other factors involved, of course, but sometimes you look at it and you go, boy, oh boy, that had to be someone with better information than the masses. Had to be. I mean, it's just, and we are speculating, of course, because we don't know for a fact, but the way the indicator turns, and then suddenly there's like a takeover announcement or a brilliant earnings or a terrible earnings, and it's been there in advance. Now, of course, that's not going to happen every time, but there just are times. I mean, normally the best use of OVI for discretionary trading is when we're already on a trend and we're going to go forward with more of a trend at a low risk entry point. But there are just times where you see something change its personality from the OVI perspective, and then in the days and weeks afterwards, the stock price follows. And that's really, really interesting to see. And of course, it's not going to happen every time, but there are markers from a quantitative point of view and from a discretionary point of view that go, oh, that's interesting. And we go out with the expression, someone somewhere knew something. And we know that happens in the stock market, and actually we want that to happen because that's how we can otherwise prices would always be the same. But there are just times it picks it up very nicely. So of course, one of the things that we work on all the time is how can we pick up those times more often than not. And so that's the game. That's our particular niche. And of course, there are zillions of different niches out there in the trading world, some of which are a little spurious and use data that's not really connected with stock pricing and stock markets. If you go to, looking at planets and moon cycles and sunspots and all that, that's something we find a little bit strange because there's no actual link and it's just too far-fetched for words. But we look at demand and supply in terms of the shares themselves and the pricing, of course, and in terms of the derivatives as well. And we think that is a little more logical and a little easier to defend in terms of a methodology. So, I'll put it to you this way. We work with funds and et cetera and professionals. Now, if you go to a fund and you say, and they ask what your rationale is, and you say, well, I'm looking at the moon and seeing what, they're just going to think you're a whack job, right? And they would be right to think that. Whereas if you say, well, look, we're essentially looking at demand and supply at a specific level, then that's a little easier to defend.
Isn't it like whoever wins the Super Bowl determines who's going to get elected for the presidency or something like that? All these disconnected things, they're good fun, but they fail quantitatively. And so even with our discretionary strategies, we look to see if there is a mathematical edge underpinning it first. Because if there is, then it's not just being quite a skilled trader in terms of managing your risk, which is an important part of trading anyway. It's that, look, I'm going into this game and underlying the entire game, there is an advantage that I have here. I'm playing. Now, I can still screw it up by bad trade management and just, bad trading, because you still need that part as a discretionary trader. But, if you're playing a game that has a dice that is already slightly tilted in your favor, then you've got a better chance. And obviously, if you're using logic, then that reduces the noise of all these other weird and wonderful things out there. And I don't want to say too much, just in case you guys are into the moon cycles and sunspots and stuff. But there's one, I won't mention names. There's one quite famous market commentator. He sells a lot of newsletters,
he was talking about his thing, and well, I'm not going to mention what he does, what he focuses on, because then you'll know who it is. But it had some sort of potential basis in economics. And then he says, he goes to me, well, what I found really interesting is there's the 29-year sunspot cycle. And I was going, oh, God. Yeah. God, okay. I think I'm going to switch off right now. I think this is a guy, because if you're really looking at 29-year-old sunspots, 29-year cycle, then I think your core methodology probably isn't working and you're grasping at something that is rather spurious. Now, if anyone's insulted by that, apologies for the offense caused, but truly, there is, if you look at what Victor's doing, Victor, you're talking about real news, real economics, real factors that one can actually defend. And these other things, that we're talking about, like sunspots and lunar phases and this, that, the link is just not direct enough by any stretch. It's very far-fetched. So, I like to be grounded in the reality of demand and supply.
Well, as a very famous contemporary philosopher and options trader said, anyone can get fooled by randomness pretty easily.
And that's part of the game that we're also up against, is just noise.
Yeah.
And that's why in our fund management businesses we go longer term, but obviously in discretionary trading, you have to be a little shorter term, but then we're hit by more noise factors.
Oh, the noise. I guess I want to take us on a little tangent. You both have you've written some books, guys. You've probably written thousands of articles, Victor. So maybe let's talk about some of the writings that you've done. Like Victor, in terms of writing and for the different news outlets, what are some interesting stories that you've come across in terms of just trading, and then also some have you broken the markets with some announcements that you've come out with?
Well, I haven't broken any publicly listed companies, but for certain I've kept awake some I've kept some CEOs awake at night with some of my articles. Basically, a very big part of my writing was focused on the brokerage industry itself, and it's such a rich industry to write about, because there is so much fraud going on.
Obviously not Scandinavian Capital Markets, Victor, right?
Well, you're on a clean shop. Well, we haven't been in the news yet.
Otherwise, this conference is over very quickly. Your connection's going fuzzy, Victor. I can't hear you.
So basically, I would say that the most interesting story that I've come across is about this prime broker that was servicing many retail brokers, and eventually it disappeared with their money. So that's something that normally doesn't happen to brokers, that their prime broker disappears with their money. So this was the guy was wanted by the FBI. He apparently coerced a sheikh in Dubai to become his partner. So the sheikh owned like 2% of the company, and the gun ran away with the money with 98% of ownership. He could basically do whatever he wanted and involve the sheikh just for PR purposes, to attract money and remove any suspicion if the outlet is legit.
Well, in Dubai, if you do something bad, you go to jail. They just lock you up.
Look with what happened to his daughter. I wouldn't want to mess with him. He's. What's
that story?
But Victor, it's interesting though, because my indicator is patented now, US patented, so it's not going to affect Scandinavian Capital Markets. So don't worry, guys, unless you think there's an opportunity here. But we think there's real.
I can't hear.
Yeah. Well, no, it's like it can go alongside. I mean, there might be a real interest because there are people who are looking at us right now because of the tangible success that the indicator's had and the fact it's patented, and thinking there's a broker play here somewhere, whether it's with a JV or something like that. And that's something we're really ready to look at as well, because, and this is where it gets difficult, a broker has to be very careful how it communicates with its clients. A broker can't say, use us, you're going to make more money with us. Whereas sort of people providing services can to an extent. So there lies the problem in that we've got an indicator that's patented and can't be replicated. To be fair, it's rather difficult to replicate anyway. But even if it could, it couldn't through the patent. And therefore, imagine if there's a broker in the US markets, that is, who's got it. We know that the broker market has high attrition rates, but it's also a very fluid market. Brokers can come in and out. So it's a very interesting proposition. I mean, when we're talking about brokers, and what I find with American brokers, obviously not Scandinavian Capital Markets, but with American brokers, they do make life, I think, more difficult today than they did 15 years ago. I mean, some of the platforms out there are so difficult to use for the retail investor, and I don't understand why, because the technology is there to make it easy. And I'm not talking about Robin Hood easy, which is like spinning a wheel and trading kind of thing, but putting together bracket orders, trading off the charts, trading off your mobile devices should be really easy, not only just to say buy, but also to put a bracket order in. It's not difficult, but they don't do it. And if you go, dare I say it, Interactive Brokers, Ameritrade, Thinkorswim, all these platforms, there's just so much noise in them. You just get lost in them. And so I think there's a definite space for not just the Robin Hoods, because obviously they're very successful, and eToros, but a strata above those for a more educated market where you could put in slightly more involved orders on a set and forget basis. And they're not catering for it properly with the US brokers, and I can't speak for Scandinavian Capital Markets or whether there's even a need with you guys. But certainly in America there is a need, and they're not doing it, and I don't understand why. Because to me it seems like a very obvious play. But yeah, that's just me.
I think it's just also has to do with the trader. Like they always want more, and then that's probably what you're seeing with the Thinkorswims and whatnot. They're trying to give them everything. And then it's like, how do you build or customize that to really fit your needs? We have MT4 and we have CTrader. CTrader is probably closer to the platform that you're talking about in terms of being easy to use.
CTrader.
The risk. Yeah, you can understand the risk. Exactly, CTrader. And you can understand the risk that you're putting into the markets at a given time and really control your trade. But everybody's just used to, when they're trading FX, they're just used to MT4, so they stick with it. And it's, I guess it's an alligator, because it's the dinosaur that survived all throughout the ages, if I were to describe it like something. So it just survives in any environment, really. So.
Yeah, well, eventually somebody will put enough effort to dethrone this dinosaur too. But what it is about is, well, to me, for example, what could revolutionize the retail trading platform market, particularly for FX and CFDs, is easily codable algorithms. Something that facilitates the trader who doesn't know how to code, and basically eliminates this requirement to learn the MQL4 language, or I know that C-Algo also, C-Trader has this C-Algo thing going. But yeah, why can't I just type some conditions and the machine does the rest? Like it's technically possible. It should be doable, but nobody has ever done it to that level yet.
I'm gonna answer. You got to be careful what you wish for, because what people in retail never hear, and it's really interesting because there's hundreds, thousands of retail educators out there with their systems, and there's one word that not only they don't ever say, they don't actually know what it means, and that is overfitting. And the problem with these kind of systems that you're talking about, Victor, is that by and large they are bound to be overfitted. And there's this whole big thing about artificial intelligence and machine learning. Now, we do a little bit of it as well with us, but we use it really sparingly, because artificial intelligence, machine learning is not the nirvana of trading. And I'll tell you why. If you think about a round thing, sort of, with kind of two dark things here, sticky out things here, something there and something there, that's something that artificial intelligence is very good at discerning what it is, and even various distortions of it to create different animals and whatever. But when you're talking about something as diverse in terms of the information, the data sources of it as trading and the different things one can do with price, it runs up against some real issues, because too many parameters is a function or will produce overfitting. And what overfitting basically means is that it'll work great on the testing data, but then when you run it on data that it doesn't know about, it's going to fall down, and it does. So AI is obviously something that will progress over the years, but it's not the nirvana that everyone thinks that it is. And so I think that the technology of which you speak, which would probably utilize some of that, and people do their kind of just let the algorithm do what it does, it will, I think, for better, not for worse, it would fail. And that's good, because once you get to a situation where machines can do everything, then there's not going to be any market, and that's not a good thing.
Well, of course, it's something that every trading system eventually fails. It's just about giving it enough time, so that.
Well, it also depends on how overused it is. I mean, again, we talk exactly. we talk a concept of in my world, we talk about the concept of information that everyone has, and then scarce information. And scarce information is the kind of thing that, Coca-Cola and KFC, they have scarce information. They have a recipe that no one knows, and it's very tightly protected. And that creates billion-dollar businesses. And scarce information will always work if you've got it. Insider information, or just very, very on-point analysis, or information sources that other people might not have, that will always work. So we always want those kind of inefficient markets. We never want to get to a point where the markets are even remotely efficient. It would be a bad thing. There'll be a sad day if that happens. And I don't think it's going to happen in our lifetimes, for sure. But yes, I think that there is this sort of concept in retail that, machines are the best thing. Well, we've just been talking to hedge funds, and they don't want that. They actually want more discretion in the decision-making process. Now, of course, there are some, the high-frequency ones, who don't. But hopefully there's enough room for all types of players, and that will keep the markets reasonably inefficient, because that's what we need to have a market that we can all play in and enjoy. We don't want too much efficiency.
From what we've seen over the past year and a half, the efficient markets hypothesis is pretty much dead. So I think we're safe on that.
I think. Well, what about the last day? What about the last 24 hours? That would do it too. But that's a great thing. It's a wonderful thing, and I think. But it's really interesting because what I'm really alluding to is the fact that people go, I use my AI, and marketers are always trying to say, how much AI are you using? I go, do you actually know what it is? And of course they want it. It's the buzzword. But the reality is, And I'm sure you'll probably see AI and machine learning around me and my stuff, okay? You will, because that's what the promoters want us to say. And there is a little bit, but I will tell you right now, we do use it, but very deliberately, really sparingly, because otherwise we will be overfitting and we don't want to be doing that. So just so you know, because what you'll find is in about, I don't know, 2 months time or 6 months time, you'll go, hang on, Guy was saying that AI, you should be using it sparingly. What's all this copy saying about him using AI? So I want to be on record saying we will only ever use it sparingly, no matter what the market is saying. But we do use elements of it, but just with very, very careful consideration.
Just so you know, you have to make those adjustments, right? So
it's a very large caveat.
Yeah. Well, for you guys, what about some of the books that you wrote?
The books. Well, yeah. It was interesting, really. I never really wanted to write a book, but I was just asked to. So this was back in 2001. I had created options trading software, a platform for it. And with the platform, I put instructions in there. And an author from the Financial Times saw it. And he goes, wow, I think you got a book here. Do you want to write a book? I go, I don't know. He goes, I'm going to introduce you to some fellow at the Financial Times. I think you got a book. And he was a successful author. So his recommendation probably was what really did it. But anyway, they met me and I showed them this stuff on my computer that I'd written. And they go, this is a book. We could get to a book here. Do you want to write a book? I go, all right. It sounds like fun. And so I wrote the book and then it became a bestseller. Now, when we say bestseller, let's now contextualize that. We're not talking Harry Potter bestseller. We are talking financial niche trading bestseller, unfortunately. But anyway, then they said, well, right, what's the next one? And I go, well, I have another one. I was building the Option Easy website at the time. And I said, well, here's what I can do with that. I'm building this website, but that lends itself to a really good reference guide as well. Do you want me to do that? And they go, yeah. So I created the Bible of Option Strategies. I was building the site here and copying and pasting it into a book format there. And so that then became a bestseller as well. So, and that really is just a reference guide to all different types of option strategies and how you use them, when you use them, risk, rewards, that kind of thing. And so those two have gone into third and second editions, respectively. I've written a couple of other ones that I actually rate potentially higher, but they haven't sold as many. But here's what happens. It's going to be a little controversial here, but it makes it more fun for everybody. Here's what happens. So I created the OVI indicator, and you have to understand that to create an indicator using billions of rows of data over many years takes enormous resources. And we are a pretty small operation. So it had to be done slowly, methodically, carefully, but it still took time, still took a lot of money as well. So when in total, I've obviously spent cumulatively millions of dollars on this thing, which is now fueling hedge fund performance and other things. But when you mention it in a book, this OVI, and you explain it and all this, obviously, within the context of a $20 or $30, $40 book, of which you get a tiny royalty, okay, you are mentioning it because ultimately you're hoping there'll be enough interest in it for people to say, I'd like to check it out a bit more, maybe subscribe, etc. Remember, millions of dollars of investment have gone into this indicator. Well, what happens is people read your book and go, oh, he's just trying to sell his indicator, 1 star. So what happened is in the first editions of both those books, they were 4.5 stars and literally rave reviews and this and that. The minute I then did the next editions and wove in chapters for OVI in there and then wove it into the fabric of the book, oh, he's just trying to sell. Well, it only took a little bit off, but there were people who then criticized, oh, he's just trying to flog his. Guys, let's get real. Do you realize what goes into this stuff? And there's only so much one is not going to make a living out of a financial trading book. And we're not meant to either. It's there because it was, I was asked to do it. It seemed like a good thing at the time, a bit of fun, something different. and also there is something about teaching that either further crystallizes what you know or gives you more ideas for what you should do better. And that's really the big thing about being in the education space, I've found, is it's just made me miles better. And it's forced me to improve all the applications I designed and build, and to a point where, hang on a second, we're now servicing professionals and talking with hedge funds, and we've got funds under management, and that wouldn't have happened. So sometimes by being forced to communicate what you do and being forced to be a better communicator, you actually improve what you're doing at your core. So that's been my journey. So the books, which was your original question, have been really a bit of an eye-opener for me. So I suspect that I've learned every bit as much, if not more, than the people who've read my books and been to my, workshops and used my software. And it carries on being a steep learning curve. And that's why we are known for always pushing the barriers and improving all the time. And then when you get into that cycle of life in your career, and Victor, it sounds like you're in exactly the same spot, you then get addicted to getting better and better and improving. And now you're in this vortex where you just can't, you've got a pipeline of 2 years worth of work always in front of you in terms of improvements and innovation. And I will say one thing, innovation is a real addiction. Once you're in it, it is the most fantastic place to be, because life is never boring. And that's a fortunate place to be when you're in sort of fintech, which is what both of us are in.
Yeah, and I couldn't agree more that once you get the gist of something and you try to spread your knowledge, try to share your knowledge, you learn more by sharing this knowledge and come up with something new and build on top of that. So it's like an endless cycle of perpetual innovation.
But it's a fun thing, it's and by the way, there's a reality to it as well, because it's basically innovate or die as well. So but it does kind of, it's like, when you did exams at school, you think, when you look at it, like, a year before, you go, how am I ever going to do that? But then when you're in it and all your pals are having to do their revision for their exams as well, you kind of just get carried along with it. And that's kind of like what fintech innovation is like as well. Once you're in it, it kind of has this energy of its own. And so, every day I wake up and I do this and do that, have a shower, and then ideas are just flooding in. And then we're talking about it, and then we're conceptualizing it. And it's just, that's what my life is now. And you travel, you go on holiday, you go on, and ideas are forever sprouting. And now I've been in a career before all this where nothing like that went on. So it's rather fun. And it doesn't always feel like work, albeit that it is. It doesn't feel like it, because it
never feels like work.
Well, it depends on the coding and stuff and the
well.
So I don't know about you, Victor, but I work with quantitative analysts, and let me tell you, working with those guys, because what they do is this. It's a very interesting situation. I am a very visual guy. So all the ideas I've had come out of visualization of an end result or of data. But quants, we're talking about egghead quants. They don't do that. They refuse to visualize data because they say that it will skew them. It will make them curve fit. And so they don't do it. So they just literally send me over these spreadsheets and no formatting. And let me tell you, when I get sent those, I have two reactions. I'm joyful because I'm hoping to find something and it's fun to actually, but every single time I have to go in and reformat the whole thing and turn it in. And that's when it's work, right? That's work. that isn't playtime at all. So, but yeah, but it is really, it's a fascinating thing. We should talk, just to see what's going on, because I'm just fascinated. I'll never get into your kind of stuff, because one thing I do realize is that you've got to kind of stick to your niche, otherwise you spread yourself too thin.
Sure.
But yes, it's a very interesting, you never stop learning, and I think that's a very exciting thing. I have an anecdote. I won't tell you who it was, because to preserve the dignity of the departed. But let's call it a relative of mine, an older generation relative of mine, asked me once in my 20s. I'd done not only, I think I'd done my second degree at that point. And anyway, so asked me something. I said, well, I'm doing this thing. And so why are you doing it? I said, well, because there's just so much to learn. I'm just, absorbed. He goes, what do you mean? You've already done a degree. There's nothing more for you to learn. And I literally, even then at my young age at that point, I knew that was probably the most insane thing I'd ever heard, because, here I am at 50, and I don't think I'm even 10% of my learning journey at this point in time, because it's accelerating so much. So whoever's out there listening, I am no guru, I'm no life guru or anything like that. But if you can get yourself absorbed into something which compels you to learn, and you enjoy that learning, I think that might be one of the secrets to being happy.
Well, you got kids, so they're going to teach you everything that you don't know yet. So.
Well, you should know what I'm teaching my 4-year-old son right now. Now, that's not repeatable, what I have to teach him, but basic hygiene and cleanliness, let's leave it that way. We're at that stage right now.
I like it when they can wipe their own butt.
That's what I was talking about. That's exactly what I was talking about. And I'm saying, yeah. So is this right? Am I in a financial conference here? And we're talking about, so the way I do it, I say, look, you gotta dig for a little bit of treasure. And when there's no more treasure, that's it. The game's over.
This is what I got to look forward to. Great.
Well, yes.
I'll take that note. Dig for treasure.
Well, you gotta find metaphors. With mankind, human beings like metaphors and stories. So that's somehow you got to figure that one out. But yeah, and boys find the whole process very amusing, by the way.
Yeah, we like to play in the mud, so I get it.
They find the whole thing very amusing. My girl is only 13 months. We have this ahead of, in the next year or so, and we'll find out what the difference is. I suspect she'll be a little bit more mechanical about the whole thing, whereas my son is, as you say, he thinks it's playtime.
Playtime. There you go. Nice. Well, I remember seeing the options Bible. A buddy of mine was reading that. He's like, I'm going to trade options. I'm going to know everything about every strategy. I was like, well, you got to get it right. Read that.
And that's exactly the wrong thing. I mean, it's really interesting. But, when people come to my event, I go, look, I'm going to teach you 12 strategies, but you are going to specialize in 3. You're going to know. And you guys know this as much as anyone. Most of the things you need to know about trading are things that you'll never use in trading, because you've got to have the periphery vision as well to know what works, what doesn't work, and just have that background. An awful lot of trading as well is also knowing when you've got something and saying, right, I'm going to filter everything else out now. I've got my speciality. And there are many specialities out there that are valid, and there are then 1,000 times more that are not valid. And that's the issue. So, we're not the only ones with just a valid thing. There are others out there, but it's just having that experience of knowing what's not valid and then the one thing I want to say to anyone watching right now, what isn't valid is stuff that isn't to do with the thing that you're trading. So if it is some kind of planetary thing, please just think it through. Think about the logic of the connection that you're making. News is important, and there are things out there that can make news workable within a trading strategy. That's the kind of things that Victor's doing. Demand and supply, when it reaches shares, share volume, options volume, that's logical. That could work. Lots of things about it couldn't work, but there are things obviously that could work. So focus, do the smell test. Smell whether the premise of the strategy actually is embedded with logic. And if it isn't, then just move on. Because, when it comes to these magical number systems, they sound so compelling. Oh, it nailed the high, it nailed the low, and a broken clock also nails the high and low twice a day. So think it through, because what that will do is that will dramatically reduce the universe of your, let's call it, holy grail hunting. Now, that's going to reduce your workload enormously. Then you've got to find out which is the thing you want to trade, whether it's stocks, options, or other instruments, and then what is the strategy that you're going to follow. And I will say one thing here. I don't know whether you guys are massive into technical analysis, but institutions don't use an awful lot of technical analysis because it's just not very provable. Quants don't use it. And if something is not provable, then you are in the realms of something else. If something is not even testable, then you got no chance. And there's an awful lot of the stuff that I've mentioned today, without going too much into it, but things that are unrelated to trading, which isn't even testable. So if it's not even testable, forget it. So it has to be testable, and then you want to then see if it's actually provable and proven. That's the three things, even before you start. But I think I was going to go down another rabbit hole there. But yes, one more thing about technical analysis is that there's a lot of people who use MACD and stochastics and all sorts, and we don't. And I'm not saying that we don't and we're the only ones who are right out there. But again, you have to examine why an indicator may or may not work. And the problem with things like stochastics and MACD, which are very popular, is that they are entirely subjective. So why should it be that one stock could have one setting for MACD and stochastics and it should work then on another stock in another sector? Because actually it shouldn't. Also, they're backward looking. So what's that going to tell you? And what I would argue is this. If someone has got a stochastic MACD or that kind of thing and they're working, I will pretty much guarantee that's not what's making it work. I would pretty much guarantee their trade plan is what's making it work, because a trade plan is also an essential part of a discretionary system. No matter what you use, if you're using OVI, you still need a trade plan. Using Victor stuff, I will bet you Victor will tell you you still need a trade plan of entry and how you exit. Am I in the ballpark?
You're quite close there. I mean, what I've come to realize over the past 15 years is it matters much less whether you're going to guess the direction of the market than how do you approach the market, how do you systematize your approach, how do you put your orders in, if you will, and how do you structure your trades.
How you manage risk is what you're saying.
Yeah.
And so this is it. With all the information now, your information, my information, what that's designed to do is to give you more edge.
Yeah.
But still within the context of managing risk. And so the way that we approach the markets, Michael, is in three ways. We have market timing, stock selection, and trade management or risk management. And those three, each one of those has its own system. So market timing, short, medium, long-term indications. Stock selection, that's where the real alpha is coming in, the real edge. And then obviously containing risk through a trading plan. How to enter, which is all about control. Then how to protect even a modest profit from turning into a loss. And then what if this thing keeps on going? Well, you also need a mechanism to say, well, don't just bail out at the first profit, because sometimes it's going to run and you're going to be on that ride. Yeah. You need a mechanism for that too. And then finally, is the entire approach, is the entire system embedded in some kind of empirical evidence as well, which is what we obviously major in as well. That's our system. And when it comes to stock selection, we have another system within that silo. And what we call that is, we call it like the big money footprints, because our philosophy fundamentally involves following where big money goes. And again, for simple reasons of supply and demand. But we like to follow big money, not just at the stock level, but also at the derivative level as well. So that's our system in a nutshell. Market timing, stock selection, and trade management, risk management, and each one of those has its little processes within it.
Well, we've gone past the hour, but it's all been fun. I want to give each of you a chance to give some final words. Guy, tell us a little bit about TradeStar. Victor, tell us a little bit about TradeStar, and Guy, tell us a little bit about Wise Traders. Sorry for the mix-up there. So, Victor, take us away.
All right. So, I'm actually going to take this opportunity to address every trader out there and just basically share that what's most important for you to succeed is to overcome your biases and to manage risk, as Guy reiterated earlier. So basically, while you keep putting more complex stuff on top of your approach, in reality, the German architects have stated about 70 years ago that less is more. So just don't get too carried away in trying to overcomplicate your approach to the market.
Awesome. Guy?
I'd like to say that as well, because that's so true. It's just a real truth of the market. We have the thing, when people do their webinars and whatever, they always come up with some guru who's come up with some quote. And I don't do that, because some life-changing quote. But we do come up with something different, and that is this, on top of what Victor said, and that is this. So we have we have 4 letters. It's called TWYS, and it's not a ticker, but it's a mantra, and our mantra is trade what you see. And what we mean by trade what you see is, what do you see? Well, we see what we call big money footprints. And the big money footprints, when we're doing our stock selection piece of what we do, are indications where, in a bullish sense, buyers seem to be overwhelming sellers, and in a bearish sense, where sellers seem to be overwhelming buyers. And to that end, what we look to do is simplify a chart. Simplify it in terms of not having lots of indicators and angles and numbers and squiggles all over it, but literally trying to anthropomorphize what you're seeing. Who's winning the game, buyers or sellers, and is there an angle here? And so we say trade what you see, and what we see are those big money footprints, which I won't go into right now, but the big money footprints are where we can see potential large activity, not only present now, but also with good reason to continue. And when you have a change in the dynamics of supply and demand, where buyers and sellers are overwhelming each other, that's where you're going to get price movement. And once you understand that, then you have a chance. Wrap a good trade plan around it, then you have a chance to contain your risk while that's happening. And if you have a system to do that, as Victor says, a simple system, then you have a really good chance of making this work.
Awesome. Well, Guy, Victor, thank you for joining us. Everyone who's watching, thank you for watching, and we'll see you again in a couple of weeks. Take care, everyone.
Thanks for having me.
Thank you for your time. Cheers. Bye-bye.